Okay, so let's talk a little bit about your trading. And so now you sit around and you're examining vol surfaces. You're looking for things. You already mentioned that you don't like being outright short volatility because you like to sleep at night.
Yeah.
So walk us through what, as a vol trader, what you're looking for and what attracts you about certain trades.
Yeah. So volatility, like I think that looking at volatility surfaces for many years just gives you a lot of like things to think about, like because you always ask yourself, okay, what do I think about like the term structure? Is the term structure too flat or is it too steep? Is the skew too steep or is it like too flat or
So
is the skew?
why don't we actually explain both of those? So let's start with the term structure. Why don't you explain to people what you mean when you're talking about the term structure of the volatility
Yeah,
curve?
so term structure basically we look at the money volatilities across different expiries.
Okay.
So we look at the money volatility for 1 day, 1 week, 1 month, 3 months, 6 months, and so on and so forth. This is the term structure.
Right.
When usually in time of like quiet markets, the term structure is upward sloping because no one afraid from volatility in the short term, but they always afraid from volatility somewhere down the road, like let's say 3 months, 6 months, 1 year from now.
So what that means in English is that we people will pay more for farther dated options in general, and that's a normal kind of volatility term structure that we'd be looking at.
Yeah, exactly. So if we look at like the VIX term structure, it's a good example, and we see that like we've got what we call a roll down of VIX futures. Why? Because the front month expiries, they price the lower volatility than the back end or the further expiries. Why? Because like insurance company, like asset managers and portfolio managers that like in big asset managers, they would pay for protection on the back end of the curve, but not on the front end because the market tends to be quiet like in most periods, and no one wants to own the option, the volatility in the front end of the curve. They always want to have a protection on the back end of the curve.
Right. So then why don't you explain skew, and then we'll go and we'll talk to
So skew tells you basically what the implied volatility across strikes and not expiry. So per expiry, what the implied volatility across different strikes. So let's say in equities, usually in equities, we have a negative skew, meaning that the puts are priced at a higher volatility than the calls. Why? Because everybody wants to buy protection against a drop in equities and not a move higher in equities. Makes sense, right? Because we all own equities, we all own stocks, and we want to protect ourselves on a down move.
Right, and not only that, the old adage that the stock market takes the staircase up and the elevator down.
Yeah. I think that Jem Corsan said that a few times.
Yeah.
So no one is afraid of a melt up in equities, but they're all afraid of a meltdown.
Although these days maybe we should be. Okay, so you've sat there in years of watching different volatility surfaces. You see stuff that's mispriced, and are you trying to arbitrage between them?
Yeah. So I like throughout the years, I started trading multiple strategies, but essentially they will all be long front end volatility, which is underpriced compared to what I think realized volatility should be, and emphasis is on what I think realized volatility should be and not what it is, and be short like expensive back-end volatility that I think is mostly overpriced due to market structure and just risk premium.
Okay, so on the whole, you like to be long the short-dated stuff because it generally trades too cheap versus realized.
But again, it depends on the assets that I trade and like and on the expiries on what I think the realized volatility should be and not what it is like right now. Because people say, okay, so let's say that we look at like S&P 1 month realized volatility, and we see that let's say that it trades at 12. Let's say that like S&P 500 realized volatility is 12, but and we see that implied volatility is let's say 16. Okay, against 16, right. And so we say, okay, I think that the implied volatility is a sell because it realized 12, but is it going to realize 12 for the next month? Maybe yes, maybe not. So you should have some idea with regards to what you think realized volatility is going to be 1 month into the future.